You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm Kerry Lutz. Well, hey, economy, the job numbers appear to be strong, but are they a lagging indicator or a leading indicator? Well, my next guest will explain that to you, Edward Siddell. Edward, it's great to have you on. Your firm is really at the forefront of retirement planning, EGSI Financial, I should say. And we're really pleased to have you on. So
thanks for having me.
What do you make of the economy? What's going on here? Is it recovering or are we in a recession?
No, we're in a recession, I believe, and I think it's going to continue on. What we continue to see is everyone's looking at one report. One data point here, maybe a couple data points over there, and no one's looking at everything together. And so, when you had the ISM report that came out, it was showing that unemployment was high, and so as a result, we saw the market go up almost 6% last Monday and Tuesday, a week ago. And then, when the jobs report came out, they were better than expected. And so, the market took back basically all the gains that it gave, earlier in the week. And, we think that the Feds are going to look at that and they're going to continue to hike rates. We'll probably see another 50, 75 basis points in November. And then, we'll probably see another raise in December if things keep going the way that they are.
All right. So another raise. How high do you think rates are going to go before they have to pivot and start cutting them? That's really the question here.
It is.
And the market is gambling on this. It's going to happen at some point, right? But we just don't know when.
Well, that's the $1 million question, isn't it? And it's when we look at not just the U.S. economy, but globally, there's a global slowdown. We saw that with OPEC. So what they did was they cut 1 million barrels. It was anticipated. They wound up cutting 2 million to get ahead of the lack of demand and the slowdown, from just not just from China, but from the U.S. and all the other countries as well. So we believe that it's going to extend into 2023. We think 2023 is going to be a tough year, and we'll probably see maybe one more raise in March. And then the Feds are going to take a look at it and say, okay, now because the recession has hit everyone so hard, can we start kind of backing off and then start lowering rates?
Okay, so it's coming sooner or later. We know that.
Yes.
It kind of has to, and the worse the economy gets, the faster it goes down. The sooner that Powell pivot's going to actually occur. It kind of reminds me, Powell, he's like a poker player and he's got the worst hand at the table and he knows it. And he keeps pushing in chips and pushing in chips. And everyone knows he's got a losing hand, but nobody's willing to take the risk that they're going to go bankrupt calling his bluff.
That's a great analogy. And you're exactly right. And they're also playing catch up because, last year, not only Yellen, but Powell, they didn't really believe that we were in an inflationary period. They kept saying it was transitory, it was temporary, basically. And so now they're playing catch up. And so the pain is going to be a lot more, and we're already starting to feel it right now. One of the probably more disturbing data points is when you see the retail sector cutting jobs as much as they have right before the busy season. So, again, that's a sign of things to come as far as the economy slowing down. And that leads us to believe that, towards the beginning of next year, we're going to start seeing some changes, we hope. So that's, and that'll give Powell a little bit more breathing room to say, we may do one more raise and then they can start backing off.
All right. So what is your take, though, on the ultra strong dollar? I mean, let's forget about whether it's the best looking horse in the glue factory or the nicest house in Baltimore, whatever. But the dollar is going to major multi-decade highs, and that's creating instability, global instability, economic instability around the planet.
You're absolutely right. And I agree with that completely. Probably we're not going to start seeing changes until the dollar weakens. And again, we believe we're not going to start seeing that until end of the first quarter of next year, when we start seeing everything start to slow down. And it's going to be painful. It's going to be painful for everyone in the U.S. It's going to affect a lot of retirement accounts. For sure. And as that dollar weakens, that's when we're going to start to see the rates kind of come back down.
All right. So, but how much damage here, Ed, is going to be done before this happens?
A lot.
Are you going to have a full scale, really deep recession like the last two, or is the money flow from overseas going to offset all the Fed's noble efforts to control inflation?
I think there's the potential for it to be very deep and painful. Especially if we continue to, if the Feds don't raise the rates as much as they need to, both in November and again in December. I think that recession is going to get deeper and longer. It's pay the piper now or later. So we really have to decide, do we just want to rip off the Band-Aid now and make it painful and have it end quicker, or kind of drag it out like we saw in the 70s? And I don't think anybody really wants that.
Yeah. Well, so he's got to hold off till the last possible moment, right?
That's right. Absolutely.
And when is that last possible moment? I know you don't know, I don't know, but we have.
I wish I had that crystal ball.
But we have an idea. I mean, this isn't totally being done in the dark, is it?
No, I don't think it is. But again, there's so many moving parts. There's so many things that have to fall into place for the outcome that we all want to happen as soon as possible. But again, there's so many different things, not just here in the U.S., but globally, that are going to affect it. So, and we've got the PPI numbers and the CPI numbers coming out on Thursday of this week. We've got the revenue numbers and earnings numbers that are coming out on Friday for banks and financial institutions. Those are lagging indicators. So I think that's really going to give us a good idea as to the track that we're on and really what's going to happen in November.
All right. So you don't sound overly optimistic, though.
No, not optimistic. I think more pragmatic. Cautiously optimistic. And in this kind of environment, I think you really have to be.
Mm-hmm. Yeah, well, optimistic. So the pain is temporary, or is this recession going to be different than all the others?
I think that remains to be seen. It is going to be painful. It is going to go into 2023, depending on how we handle it and what Powell does and how the Feds actually manage that is going to really determine the outcome. Not only the strength of the dollar, but interest rates and how painful and how abrupt the recession is going to be. And when it's going to end. All
right. So, obviously none of us know this, right? None of us have any idea about it. But is he going to be like James Dean, rebel without a cause, riding that car right to the edge and then get stuck in the driver's seat and go off the cliff?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Let's hope not. And you know what? Honestly, I think he learned his lesson, at the end of last year and the impact that it had on the first and second quarter of this year in 2022. So he is a little more thoughtful with the outcomes what they're doing and also the words, when he talks and delivers, their decisions. So, again, being pragmatic, cautiously optimistic, I do think short term it is going to be painful. But there's a lot of things that need to happen. Also when you look at the market and, with the amount of retirement savings, that has already been lost, it's really important to understand how leveraged the market is, right? So these decisions with rising interest rates, the impact that it has on market volatility, we're seeing right now, we believe a race to liquidity. That's why everything in the market is being correlated. And so all these things are going to have an effect on the outcome. But again, I think it starts with Powell.
So what are you telling your clients here, Ed? How are you positioning them to avoid the worst of what's about to hit upon us?
Well, believe it or not, we started moving the cash at the end of January of this year. We have a large position in cash, obviously short term, 1-year treasuries, because we again being cautiously optimistic, depending on the outcome of the midterms. We think we might get a bump. We want to be in a position so that two things are going to happen. Number one, retirement savings are being protected. And number two, we're going to have that opportunity when things turn around to be able to make up, what we lost as a result of inflation, and put people in a better position much sooner.
Okay, so moving ahead here, cash is king, even though cash is trash because the inflation rate is high.
Right.
Everything Powell's doing might very well not bring it down, or might bring it down temporarily. I mean, look, when you and I old enough to remember the last inflationary cycle in the country and the world, which was back in the 60s, 70s, and 80s, and it took Volcker raising rates to double digits, 20%
Right.
rates, to crush it then. There's no talk of 20% interest rates here. The world economy could not sustain it, could it?
Oh, it would crush. It would crush the U.S., especially with the mounting national debt that we have. We wouldn't be able to service it. So, and that's part of that big delicate balance where they need to stave off inflation and keep it from increasing. But they also have to make sure that they don't strangle the U.S. because we wouldn't be able to service that debt, especially at that interest rate.
All right. Well, hey, so. We kind of got a Category 5 hurricane coming at us. We see what happened to the west coast of Florida.
Yes.
The global economy could be looking like Fort Myers, Florida soon.
Yeah, let's hope not, but it could. Unfortunately, I think you're right.
I mean, credibility-wise, does the Fed have any credibility left? Look, they were buying $65 billion a month worth of treasuries, mortgage-backed securities. Real estate prices were booming. Mortgage money was plentiful, and yet they keep buying it and buying it. They could have raised rates a year ago, 25 basis points every other month or every 3 months.
But when they should have, right? Absolutely. Yep.
Yeah, and but the Fed is like the Pope, like my mother. My father always used to say, she may be right or wrong, but she's always your mother. And the Fed is usually wrong, but they're your Fed, right?
Yes. Fortunately or unfortunately, and I think right now it's more unfortunately. Again, the fact that they're still buying treasuries, it doesn't make sense. I mean, we should be getting this off of the balance sheet. We should have been raising rates a long time ago, and that's why we're playing catch up right now. And we're seeing the negative impact that it's having on all of us, we're seeing at the gas stations, buying, at the grocery stores, no matter what it is. And I think we're going to continue to see that. And that's why I believe that it's going to be painful going through 2023.
And really, when you're talking about the current situation, inflation, there's a fiscal side to it that's being totally unaddressed. The Congress, government spending money like drunken sailors. Not to insult drunken sailors, mind you, but they are. And until we get our fiscal house in order, what choice does the Fed have? They got to print money.
Yeah, and that's what's so sad, to be able to spend what we have spent over the last couple of years. We spent more in the last 3.5 years than we did in the first 225 years of the country. And so that, that's an impact. What frustrates me more than anything is when I hear we're going to spend our way out of debt. I mean, when have we ever done that in our own house, right? I mean, you can't borrow money to get out of debt.
Yeah.
It just, the common sense. I think that's what we're missing in Washington right now. The Congress, they really haven't done their job, and they haven't for a while. So until they get their house in order, we can't get the country in order.
Yeah, nobody is real anxious to actually put the fiscal house in order. That's a whole story for another day.
It is.
Cash, short-term treasuries, short-term bonds out there, out of junk, AAA corporates. What do you do?
Yeah, I'm not a big fan of bonds right now, other than treasuries. And the reason is because the market is so over leveraged. If there's the report that came out from the SEC and FINRA through December 31st of last year, and it said that just the S&P through margin accounts, they were leveraged. We were pushing $520 billion in borrowed money into the market, and that was a little more than 5 times what it was, right before the housing bubble popped. So, and that's why we're seeing, this, everything is correlated. So typically, in a market, when you have volatility like this, you've got one side going up while the other side is going down. All right. And when you have commodities that are going up and down with the S&P and the Dow and the NASDAQ, what that's telling us, which is why we started moving to cash in January this year, it's a race to liquidity because there's margin calls. Now, and we're assuming that, when we're looking at cryptos as well, that's highly leveraged. We believe that there's a correlation between, not just debt in the market, being over leveraged, but consumer debt, corporate debt, as well as the national debt. And so until some of that debt kind of gets off of everyone's balance sheets, we're going to we're going to continue to see an awful lot of volatility.
All right. Well, yeah, crypto is interesting. That's
a whole topic. That's for sure.
Whole different one. Yeah, I guess we're in this mess, and they're going to have to ride it out and hope that the carnage isn't too great. But I don't have a lot of confidence in the Fed personally. It doesn't sound like you have either. So we're just going to have to see. Ed, people want to find out more about you, connect with you on the web. How do you do that?
Yeah, you can look us up at EGSIFinancial.com. We have a podcast as well, The Retirement Trainer at Siddell, on Apple, Spotify, wherever you listen to your favorite podcasts. Or you can give us a call at 614-526-4118.
All right. Hey, we appreciate you coming on. You got a question for Ed, shoot us an email, kl@kerrylutz.com. You have a question about anything else, please send that email to kl@kerrylutz.com and go over to our site, financialsurvivalnetwork.com. Get a subscription to your free newsletter. Ed, we'll talk to you again. Thanks so much for stopping by.
Absolutely. Kerry, I appreciate it. Thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.